I'm Lee Holtz. I am Program Manager for Literacy Connections of Wayne County. Welcome to part 2 of our FDIC Money Smart Youth Edition presented by Bank Owned Wayne. In the first part, we talked about some very basic fundamental building blocks for your financial future. We just did a quick overview of some things about creating plans and setting goals and setting a budget. So we're going to start where we picked up, where we left off last time and pick up on that. So on the screen now, you see a slide, kind of a funny little cartoon slide, and you see a young man that's trying to make a decision between spending money that he has or putting it in the bank. And the caption is "Pay yourself first." So what exactly does that mean, and which one of those options speaks to that? Pay yourself first means that you are committed enough to your goals and to meeting your budget that you're going to be committed to saving money and paying yourself first. It's just what it sounds like. It does not mean that you give yourself some money and you go shopping. It means that you take some money from whenever you receive your income, paycheck, odd jobs, whatever that might be, and you take a portion of it, and the very first thing you do is put it somewhere safe. Obviously, a savings account at a bank could be that safe place. It is a commitment to your future, to creating an emergency fund, to creating a college fund, a car fund, whatever your dreams are. It's a commitment to meet that and to do it from the very beginning. If you wait until the end of the month or just before the next pay period, chances are that money's going to be gone because it is too easy to spend it on things that we want. So we create that savings account and we handle it just like we would a bill that we might have to pay. So when we think about that in creating our savings account, our nest egg, our emergency fund, whatever we're saving for, there are a couple of things that we want to talk about. Checking and savings accounts. Often when we talk about banking and having a banking account, someone will roll their eyes. They don't need to do that. They don't understand the purpose. They don't want to go through the hassle. Banks are just out to charge us high fees and all of those things that we hear. However, a checking and a savings account can be a really good place to start building your financial future. It gives you a safe place to keep your money, and it also helps you build a relationship with a financial institution that can help you as you're trying to build credit, as you're trying to establish yourself and build a sound foundation. A checking account, kind of an outdated term if we think about it. Lots of people don't write checks anymore, except for me. You can use a debit card to access the money in that account. You can pay for things sometimes directly from your phone. There are lots of ways to utilize a checking account. That just means there is an account at a bank where you can put your money, but then you can access that money when you need to pay bills, to do the things that you want to do. It's a whole lot safer than keeping it in a shoebox, in your closet, in your car, in your wallet. You know it's in a safe place, but yet you can access it when you need it. A savings account is just a safe place for you to save money. The difference between a savings and a checking account, with the savings account, you might not have access to that money whenever you want it. Most banks will limit the amount of times that you can make withdrawals from that account. A savings account will also earn interest. That simply means the bank is going to pay you a little bit of money for keeping your money with them. It's not a whole lot of money, but you will earn some interest over time. The more money that's in that account and the longer it stays there, the more interest you'll be able to earn off of that. But when you're thinking about options, remember that a checking and or a savings account is a really good place to start and invest in your future. There are lots of options now. There are lots of online options that can meet your needs just as well as a brick and mortar. Just make sure if it is a bank that it is insured by the FDIC, the Federal Deposit Insurance Corporation, and if it is a credit union, it's insured by the National Credit Union Administration, excuse me. Okay, so how does money grow? I mentioned interest on a savings account just a second ago. Interest is the amount of money a bank or an other financial institution will pay you for keeping your money on deposit with them. That is not usually true of a checking account, but it is of a savings account. So that if you have your money on deposit, they're going to pay you a little bit to keep the money there. It is expressed as a percentage and is calculated based on the time and the amount of money in the account. Compounding, that is how your money can grow when you keep it in a financial institution that pays interest. And the APY is the annual percentage yield. It reflects the interest you earn on a yearly basis. Compounding interest does make a difference. I don't have examples to show you, but it's something you can easily research. You can pull up charts. You can say, okay, if I keep $100 in a savings account at this interest rate that's compounded daily for a year, how much money will I earn? And it will show you what that percentage is. It will also show you what it would be if it's compounded monthly. So that's important to know as well when you're considering interest. There are savings options. One of those that you can purchase from your bank is a certificate of deposit. It's sometimes referred to as a CD. Typically, it will offer a higher rate of interest than a regular savings account, but in exchange for that, you agree to keep the money on deposit for a set term. For example, 6 months or more. So all that means is you can open a certificate of deposit. You deposit a set amount of money. Usually the bank will set that parameter for you, $100, $500. You agree to keep that money in that account for 6 months, a year, 5 years, 10 years, whatever the terms you agree to. And at the end of that period, your money will have grown substantially. And the financial institution can give you that information. You can pull up online and look and see, okay, if I walk into this bank today and open a CD for this amount of money, at the end of 5 years, I'll have this. The catch to that is once you deposit that money, you don't have access to it. You agree that the bank gets to hold on to it for whatever the term of that CD is. If you have to get to that money, usually there is a penalty for accessing it, so you want to know that up front before you commit the money. There's also something called a money market account. This will also earn a higher interest rate than a traditional savings account or checking account. Remember, I said most checking accounts don't offer interest. A money market account will, but in exchange for that, you agree that you're going to keep a high amount of money in your account every day, usually somewhere around $1,000. That will vary from financial institution to financial institution, but with that, you can make deposits whenever you want and withdrawals with that. So a little bit different from both a traditional savings account or a traditional checking account. A statement savings account is what I mentioned earlier on the previous slide. It's an account that typically allows unlimited deposits. You can go every day and put money in that account if you want to and you have the money to do that. But it will limit the number of fee-free withdrawals you can take during the month. Okay, so you're sitting there thinking, wait a minute, this is my money and the bank's going to tell me how many times I can go in and take money out? No, you can do that every day if you want to as well. But after a certain number of time, usually somewhere around 3, If you need to go back into that savings account, the bank is going to charge you a fee for that. The reason the bank charges you a fee for that is because it is a savings account. The idea is to save money. So they want to discourage you from accessing that money. You will typically earn money and, earn interest on the money you have in deposit. And it's called a savings statement because you will receive a statement, sometimes monthly, but at least quarterly, that will show you all the transactions, all the activity in that account. How many times did you take money out? How many times did you put money into the account? So that way you can keep up with the activity there. Another thing to remember for a savings account, if you're out shopping around for the best fit, most places will allow you to open a savings account for a relatively small amount of money. And again, that's going to vary from financial institution to financial institution. But they're going to charge you a monthly fee if you don't keep a certain amount of money in there each month. So for example, let's say you walk into a brick and mortar bank, you've got $100, they'll let you open a savings account with that, no problem, you've opened the account. But they're going to require you to keep $300 or $500 or whatever their terms are for a month. For every month, you have to keep that balance all the time. If you go below that, they will start to charge you a monthly fee for keeping the balance below their set balance. And there again, if you get into that situation, yes, you can still keep your money there, but you're not saving. They're taking money out of that account. So be sure you understand what the terms are for your savings account. Okay, and protection. I've already touched on this a little bit. You want to make sure that your financial institution is protected by the Federal Deposit Insurance Corporation. That just means the federal government insures that institution. So if something were to happen, we were to have a tremendous market crash or something tragic, your money up to $250,000 is insured by the FDIC. The same is true for a credit union. You want to make sure that the credit union is insured by the National Credit Union Administration so that you know that the money in a credit union is protected as well. Okay, but then there are some products out there beyond what the bank can offer. And sometimes these things fall under what we call predatory lending. So always be aware of this. So you're in a situation where maybe you want to borrow a small amount of money to purchase a vehicle or purchase a computer or whatever it is that you need to do. You've had an emergency and you need new tires. And there are all kinds of places. You'll see signs that look similar to what is up there on the screen. But be aware of these kinds of lending. If you've got somebody that's telling you that it's incredibly low monthly payments and you're wondering, well, why can I go to this place and get a loan for a low monthly payment? If I walk into my bank, they're going to charge me more. My monthly payments are going to be a little bit higher. Well, actually, the bank's not charging you more. They're not charging you for as long a period of time. If you've got a low monthly payment, it is quite possible that they are charging you a very high interest rate and you're paying it for a longer period of time. Instead of maybe a year, it might take 3 years to pay it off. So always look at the terms. That does not mean that sometimes we get in situations where we need that kind of assistance. Our credit doesn't need to be as high for something like that, so maybe we can get it quicker than we could through our bank. It just means if you do it, please be aware of what you're paying for that money you're borrowing. For Act Now, limited offer, usually that's just a tactic to get you in the door to take advantage of that. Yeah, that offer might expire in 24 hours, but 48 hours later, there's going to be something different. If you cannot afford it or it looks too good to be true, it probably is, and wait till you can afford it and when the next special comes along. The same thing with no upfront fees. That's great. They're not charging you fees up front, but where are they charging you? Are they charging you a processing fee each month? Is there some other gimmick in that you need to be aware of? It's not technically an upfront fee, but it is something else. So just be aware, always read the fine print so that you know exactly what you're getting into. And remember, if you're borrowing money, quite often the bank is going to be the very best place to start. Therefore, that's why that relationship with the bank can be so beneficial. Okay, so now let's talk a little bit about types of loans. And we're going to start with credit card. We've all heard about credit cards. They can be a wonderful tool as well because you can buy goods and services and pay for them over time. It allows you to borrow money for household, family, or other personal expenses. So they're the positives. So you need to buy something big and you can't afford it all at one time. It might be that emergency set of tires. You might need to replace a refrigerator or your laptop for school, and just don't have quite that much money. A credit card can allow you to do that and then make monthly payments on it and cover those expenses. But it is very easy to get into big trouble if you're not careful with your spending. Okay, so think about this. You get your very first credit card, the limit's not very high, maybe you have $1,000 limit, and you think, well, that's not a whole lot of money, so I can pay that off easily. And then you just get excited. You replace that computer, but then you think, there's a little bit left over, so I think I'll buy some shoes, maybe I'll buy a new outfit, maybe you're feeling generous and you go buy a gift for your mom, go out to dinner. Card's maxed out, you owe that full balance of $1,000. That first bill comes and you can barely make the minimum payment on it. And then the second bill comes and you make the minimum payment again. So you've maxed out your card. You're caught in the cycle of minimum payments, which if you'll look, credit card companies now have to print out how long it will take you to pay that off. And if you have another emergency, you don't have access to those funds because your card's maxed out. And then you can really damage your credit if you don't make those payments on time regularly. That monthly bill comes in and you can't make the payment, and so you get behind, you don't pay it 1 month, then it's 30 days overdue, and then it's 60 days overdue, and then it starts to really do some damage to your credit. And credit sometimes is one of those things when we're young we don't really think about. You know, credit's what you need when you're older and you're ready to buy a car or home. But it's the things that we do when we're young that can really stay with us for several years and make it harder to move forward. So be very careful if you do take advantage of a credit card offer, that you're careful with the way you spend it so it doesn't end up being that thing that follows you around and prevents you from moving forward. Another type of loan could be what we call an installment loan. With that, you can also pay some personal expenses or family expenses. But with that, let's say that's a personal loan that you get from a bank, and it's called an installment loan because you make monthly payments for the very same amount each month until that loan is paid off. So you borrow $500 for a year, you have the same payment every month until that is paid off. Just like with a credit card, it can damage your credit if you don't pay that loan on time as you have agreed to do. So that's very important with that type of loan as well. For any money that you borrow or any debt you owe, it is very important that you pay that debt on time with the terms that you agreed to, so that you're not damaging your credit. Credit report. We've been talking about credit. Well, there is a credit file on you, and it has all of your debts. Well, I'm sorry, not necessarily all of your debts, but all of the things that you have purchased with credit and all of your credit accounts. This is an extremely important document. It has all the information about how you've paid those bills, who you owe money to, how many credit cards you have, and are you paying those bills on time? Do you have something called slow credit where, yeah, you pay your bills and you pay that minimum payment, but you might be running 10 days behind and not 30? So there's a lot of information, and a lot of people can look at this report. So what is in there really does matter. In some cases, a prospective employer can look at your credit report. In the first section, we talked about your dream job. Well, wouldn't that be awful if you get the skills you need for that dream job? You have an opportunity at that, and then they pull your credit report and they have some questions about what's in there. So you don't want that to be the thing that holds you back. A landlord. You're getting ready to rent your first apartment and you're so excited about that. Your landlord pulls your credit report and looks at it and thinks, this person might not be a really good risk. You might still be able to get the apartment, but your security deposit might be higher. You might have to pay more for that. So think about that as well when you're building your credit report and you're starting to use credit. You want this document to work for you, not harm you. It can also be you're getting ready to buy a car, and you can get the car that you want, but you realize you're paying a tremendous interest rate for it. That could be because your credit score is not quite as high as it needs to be. Someone with a higher credit score might be able to get the same car for a lower payment. So that's something to think about. So credit reports follow us around. There's a lot of information in there. It is up to us as consumers to know what's in there and to dispute it if it's not correct. I'm not going to go into a whole lot of detail about that, but there are some resources in your participant packet that does provide that information. It tells you how to build a credit, good credit, so you have a credit history, and it will also tell you how to check your credit report so that you can see what's in there. It's always a good idea to know what's in your credit report and make sure that it's accurate. Okay, so 2 truths, 1 lie. Credit cards are used to purchase goods and services, take money from your checking account when used to pay for purchases, are subject to interest charges if not paid in full each month. Okay, so which 2 things are true about credit cards? Okay, number 1, they can be used to purchase goods and services. And number 3, they are subject to interest charges if not paid in full each month. And watch those interest charges. That can really add up in a hurry. So, what's the difference between credit versus debit? There's a very long, comprehensive list in your packet that you might want to refer to, but we'll just run through this really quickly. Which card requires you to have enough money at the time you pay for something? That, of course, would be your debit card. You have your debit card, you slide that to pay for something, that money is going to come out pretty much in real time out of your account. So before you swipe that card, you want to know that you have enough money to cover that. You also want to know how your bank is going to handle it if you swipe that card and there's not enough money there. Is that card going to be rejected? You can't make your purchase, it's been denied. Or is your bank going to allow that charge, but then they're going to charge you an additional fee for that? Be sure you understand how your account works. Okay, so which card's balance can increase and accrue charges if you do not pay the entire amount each month? That's your credit card. So with your credit card, if you're not paying the entire amount each month, you're just paying that minimum or maybe even a little more than that minimum, that balance can continue to grow and accrue charges if you don't pay it. It's going to charge you interest. If you're not paying it on time, there might be some late fees, so keep your eye on that as well. Which card may have fees associated with it? Okay, that actually could be either one, and you want to know what it is. All accounts, debit accounts, operate differently, and all credit cards do. So you want to know what applies to each of yours. So fees with a credit card could be something like a late fee. It was due on the 5th, you paid it on the 10th, they've charged you a late fee. They could charge you a fee if you use your credit card to get cash off of it. So those are the kinds of questions you want to know. With your debit card, you could be charged an overdraft fee if you are allowed to spend more money than you have in your account. Your bank might charge you that. They might charge you a fee if you go to an ATM that's not associated with your bank. Let's say you're out on Friday night, you want to go to a movie, you go to the theater, they've got the ATM right there, you stick your card in there, you get your cash, and then when you look at your account, you see that you've been charged for that. They can do that. Often that charge is $5, and it's $5 from your bank, and it's $5 from the ATM's bank. So it's not $20 you took out, it could be $30 you took out. So be sure that you're aware of that when you're using your debit card. Okay, so which card generally offers purchase protection against faulty goods? Okay, that's where your credit card can come into play. Many credit cards do offer that purchase protection, and so what that means is you've made a purchase on your credit card. Maybe you got that laptop that you needed, and there's something wrong with it. It doesn't function the way that it is supposed to. There's manufacturer's defect in it. While you're disputing that with your computer company, the company you purchased your computer from, you have the right to dispute those charges and not pay for that until that dispute is settled. So that's the right that you have with your credit card and the protection from faulty goods. So that's the way, so you're not having to pay and wait for the company to refund you. Which card allows you to pay for unexpected emergencies when you don't have enough money? Again, that's your credit card, but be sure that you're very careful with the way that you handle it so that when you do have unexpected emergencies, there's enough money on the credit card for you to be able to put that in there as well. Okay, so time for a reality check when we're talking about saving and spending and putting things on credit. Okay, so here's the dream car, possibly. Something you really, really want. It's what you just think you need to have this particular car, and you know that that is a want and not a need, that something else can get you back and forth to work, but that is the car that you want. Reality might look a little more like this. That just kind of practical, compact car that has good gas mileage, you don't have to pay high insurance on, and you can afford the monthly payments. So you really want to think about that before you make the purchase. And sometimes when we go into a dealership and we find that perfect car, the dealer is going to convince us that we can afford it. We really need to think about that before we get too carried away. So what are the true costs of a car? There are lots of things to think about. And I don't know if you remember in the first section we talked about opportunity cost. Car can be a really good place to start thinking about, okay, it's not just how much I'm paying for it, it's going to be how much it cost me to own this. Okay, so what can you afford right now? Do you need a car, or do you just want one? Do you still live with your parents or your grandparents and you have access to a car anytime you need it, but you just want to be able to have your own? Or do you have access to public transportation and maybe don't need to make that investment? Or do you have a really good job and you have to have reliable transportation? So think about that. What amount can you pay each month? Don't get sucked into something that you can't afford each month. Go with your lowest possible income for the month and then think, can I afford this payment? Because once you sign on the dotted line, you're obligated to make that payment. You don't want to get in trouble and hurt your credit with your car payment. Gas. Have you figured out how much gas is going to cost you? Is it a fuel-efficient car? Does it use a lot of gas? Can you afford that? Because what good is a car going to do you if you can't put the gas in it? Will you need money for repairs? That's a silly question. Let me tell you, you will need money for repairs. Things happen. Even with new cars, things happen. It might be something as simple as replacing the windshield wipers. Or it could be something more serious than that. The transmission could go out. There are lots of things that could happen. So you need to be prepared to make repairs if necessary. Should I lease or own? That's a big question, and that's going to be a personal thing, but there again in your packet, there's some information comparing the pros and cons and the expenses involved in that. How much will insurance cost? That's a really big thing that you kind of want to know up front. That first car we looked at, the fancy sports car, insurance is probably going to be more expensive than that. A new car insurance is probably going to be more expensive than that. So you need to be sure that you've looked into all of that. What's the point in having that car if you can't afford to carry the insurance on it that you need to have? How much do you need to put down for a down payment? The more that you can put down for a down payment, the less your monthly payment will be. And think about what you can afford for 1 year, 2 years, or 5 years from now. If you're planning to go to college and you might have to stop your part-time job while you're in school, you might not want to get locked into a 5-year plan with a car payment that you can't afford. So there really is a lot to think about when you're making that purchase. So take all of those things into consideration before you sign. Once you do, you're obligated to that agreement. Okay, secured or unsecured loans. Types of installment loans. We talked about installment loans a few minutes ago, but there are a couple of different kinds, secure and unsecure. A secure loan simply means that you have to put up collateral, something of value, in order for the lender to lend that money to you. A car is a perfect example of a secure loan. You purchase a car, you've made an agreement with the lender. If you're unable or unwilling for whatever reason to make those payments on time regularly, after a while, let's say you go for 90 days without making a payment, the lender has the right to come repossess, take your car away from you. Once that happens, that's a big hit on your credit report. It's going to make it harder for you to replace that car when you're in a position to do that. But that's the collateral. That's the agreement you've made with them. You pay the money or they get the car. They don't want the car, they want your money. So be sure that you communicate with the lender. Okay, an unsecured loan is going to be something more like a credit card. Not all, but most credit cards you're able to do without putting up collateral. So that means you have your credit card, you have an agreement with the credit card bank that you're going to make your payments on time. They're going to extend a certain amount of credit, whatever your limit is, and you agree to make those payments. So therefore it's considered unsecured. You go out and buy that laptop I keep talking about or that new pair of shoes and then you don't pay your bill. They're not going to come get those things from you. You've not put it up as collateral, but you're going to do some serious damage to your credit. Okay, so we talked about cost and opportunity cost and saving for things. Often college is the thing that we're saving for. Whether we're parents and we want to do that for our children or we know that we're going to have to help fund that for ourselves. It's complicated. So I'm just going to really briefly hit some overviews here. College has tuition, how much you have to pay to go there. If you live on campus, how are you going to pay for food? Even the cafeteria plan is not included in tuition. So, are you going to have a cafeteria plan? How much is that going to cost? Are you just going to purchase your own food? How much is that going to cost? You have to have a plan for that. Room and board, okay? You've paid tuition, that doesn't necessarily include a dorm room. So how much is that going to cost you to live on campus? Okay, so what if you decide to live off campus, or you're going to a community college or a college where you live and you don't need to live on campus? How much is that going to cost you? Books. College books are extremely expensive. So, got tuition covered. Can you cover the cost of the book? Sometimes there's school fees. So what are those? Can you afford those? Technology. You have to have technology. You have to have a laptop. Often they will tell you exactly what you need. Do you have a plan for that? Personal expenses. You still have to have things like clothes and haircuts. And hey, if you're not close to home, where are you going to do your laundry and what's that going to cost? Entertainment, phone, transportation. So there's a whole lot in addition to tuition to think about. You want to be sure that you've explored all possible scholarship options. Everything from scholarship funding that the school might offer to what's available in your community. In Wayne County, North Carolina, our community college has an excellent community foundation that helps students who need help fund their education. So do research into that, but be careful. You might get a full scholarship somewhere. You're just an excellent academic student, you get a full scholarship, what sometimes we used to call a full ride. Or maybe you're the best football player in Eastern North Carolina and you can go play football anywhere you want to. But what does that cover? There are some of these expenses that full ride might not necessarily cover. I just recently heard a story about a student who was able to go to a state university and a full scholarship. It did cover room and board. It did not cover food. He was having a really hard time eating regularly and well. So there's a lot to consider. So just as you consider the cost of what a car might cost or renting an apartment might cost, you want to look at college the same way and make sure before you make a commitment that you can cover those expenses. If you do need to take out student loans, and lots of people do, you want to make sure that you're allowing for some of this, but not borrowing more than you need to have. So a lot to think about when you're planning for your future. So I just would like to close with this. What is your skill and will? I don't know if y'all remember Muhammad Ali, but this is a quote from him. Champions aren't made in gyms. Champions are made from something they have deep inside them, a desire, a dream, and a vision. They have to have the skill and the will, but the will must be stronger than the skill. So think about how that can translate to you as you reach for your financial goals and your dreams of the future. It's not just about being an athlete. It is about what you have inside of you. How dedicated are you? How much does this mean to you? Do you have the will to stick to a budget? Do you have the will to save money? Do you have the will to resist peer pressure? And it can be hard, but I think that that's a really good point. You can acquire all the skills you need, but if you don't have the will to stick with it and move forward, it's going to be really hard to do that. So in closing, we'll remember Muhammad Ali, and a reminder that these two sections that we've just gone through are not everything you need to know. It's not even deep dive into any of those things. But there are lots of great resources. There are a few we've included in your packet. We are always available as a resource. Contact information is on the screen. You can certainly reach out to me. If it is something that I don't know the answer to and I don't know where to find it, I can call somebody, and I'm glad to do that. And I'm glad to make connections within the local community for answers and guidance as you need that. So don't hesitate to reach out to us, and good luck as you plan for the future. Thank you.
This is Sherry Archibald with the United Way of Wayne County. Bank on Wayne is a Literacy Connections program and is funded in part by the United Way of Wayne County. This video series of Bank on Wayne was made possible by a generous grant from Enjoy Thrift Store, Goldsboro.